Hello, everyone. Welcome to Unit 5 Owner Relationships. We're going to be discussing a tiny bit about what it means to have a contract. So, there's a contract between the owner and the property manager, right? And then there's also contracts between the owner and the tenant. So, let's jump right in here. When you've completed this unit, you'll be able to accomplish or know the following. Be able to talk about the three different property management relationships, explain how the owner's objectives influence the final management plan, identify the essential elements of the management contract, and change of the management procedures. Recognize three methods for determining profitability, and summarize how to maintain satisfactory relationships with the owner. All right, let's jump right in. Overview. A property manager may have one of several different relationships with the owner of the property. Although the property managers who are employed directly by owners of large individual buildings may retain the right to act as agents for other owners as well, generally they only work for one employer exclusively. In other situations, a management company may act as agent for numerous individual or corporate owners, and the manager represents the company. Full service real estate agencies offer their clients property management services in addition to leasing, insurance brokerage, sales counseling, appraisal, financing, and mortgage banking. In these scenarios, the management firms and management divisions have an agent principal relationship with the property owner, and the individuals who manage the properties are employees of the management organization. After the property manager and the owner agree on principles, objectives, and a viable management plan, they must then agree on the structure of their relationship, their specific responsibilities and liabilities, the scope of the manager's authority, fees, and the duration of their relationship. The written management contract formalizes their decisions. In addition, the owner must turn over management records and other information to the manager to facilitate the operation of the property. The manager is expected to make every effort to establish and maintain a clear line of communication with the owner. Property management relationships. Learning objective. Contrast the differences among three different property management relationships. Three basic relationships can exist between a property manager and the individual or corporate owner of a building. Employer-employee relationship. Formal fiduciary relationship trust. Principal-agent arrangement. Employer-employee relationship. The employer-employee relationship is found most often in banks, colleges, large corporations, and other private institutions that require managerial services for their properties. The employee manager is directly responsible to the officers of the owner-employer corporation or institution, which may be the principal occupant of the property. Although no formalized contract is necessary in an employer-employee relationship, certain issues should be clarified in writing. In lieu of a contract, the manager should obtain from the employing corporation written authorization to sign binding leases. This authorization is sometimes limited in the dollar amount or length of lease or in the dollar amount of the repairs. Many lessees, especially government agencies and corporations, request a copy of this authorization from the employee manager. Trust. A trust is a device by which one person or institution transfers legal ownership of property to someone else to hold or manage for the benefit of a third party. Trusts are created by written agreements that establish formal fiduciary relationships. For example, many banks, trust companies, and employee benefit and pension plans have acquired income property that they hold in trust, in addition to their conventional purchases of stocks and bonds. Also, many investors use established forms of trust to help meet their investment goals. Thus, a need for property managers arises. The property owner, called a truster, transfers the legal title to property to a trustee who will manage the property and transfers the equitable title to one or more beneficiaries. Beneficiaries may include the truster, members of the truster's family, or third parties such as organized charities or an employee group. The trustee takes charge of the property for the benefit of the owner of the equitable title. If the trustee is a bank or other organization, a property manager commonly will be an officer or an employee of the trustee. In any case, the property manager is an extension of the trustee and must manage the property technically called the rage of the trust in accordance with fiduciary principles. A trust may be interims, that is, set up during one's life, or it may be testamentary, established by will. It is not possible to examine this form of ownership fully in this text because the trustee is governed by terms of the trust instrument itself and federal and state laws concerning trusts. If employee benefit plans are involved, the trustee is also regulated by the U.S. Department of Labor. Property managers who find opportunities in this area must take special precautions to learn and define the legal responsibilities and requirements of the relationship. Principal-agent relationship. The most common owner-property manager relationship is that of principal-agent and is created by a written contract signed by both parties. Agency is the term used to describe the special relationship between the principal, the one who hires, and the agent, the one who does the work. The written agreement creating this relationship is called the management contract. It empowers the property manager as agent to act on behalf of the owner or principal in certain situations. The agent is regarded as an expert on whom the principal can rely for professional advice. The agent acts for the principal to bring him or her into legal relations with third parties. The agent is governed by the terms of the contract and by certain legal and ethical considerations based on the law of agency. Scope of agency authority. Depending on the scope of the agent's authority, an agent may be either a general agent or a special agent. A general agent may act on behalf of the principal on a range of matters and may obligate the principal to any contracts signed by the agent that are within the scope of that agent's duties. This relationship usually is long-term. A special agent is authorized to represent only the principal on a specific matter or transaction. The authority is limited both in scope and time. Once that transaction is concluded, the agency is terminated. Typically, a special agent has no authority to sign any contracts on behalf of the principal. For example, a real estate agent hired to sell a house usually is a special agent, while a property manager usually is a general agent. Fiduciary duties. Whether special or general, an agent has certain duties imposed by common law or statutory law. An agent has a fiduciary relationship to the principal, a confidential relationship marked by trust and confidence that requires the highest degree of loyalty on the part of the agent. Some states require that duties owed must be identified in writing in the management agreement. Some states follow common law duties implicit in a fiduciary relationship. Fiduciary duties include care, obedience, accounting, loyalty, and disclosure. The duty of loyalty means that property managers must always put the property owner's interests first above their own interests. Property managers must act without self-interest. For example, if the property manager receives a commission for leasing an apartment, the property manager cannot simply accept any tenant in order to get the fee. The property manager must screen the prospective tenant carefully to make sure leasing to him would be in the best interests of the property owner. Additionally, the information gained by the property manager must remain confidential. In some states, the duty of confidentiality is terminated when the agreement is terminated. In most states, however, the property manager is forever prohibited from disclosing any confidential information. It is not possible to examine this form of ownership fully in this text because the trustee is governed by terms of the trust instrument itself and federal and state laws concerning trusts. If employee benefit plans are involved, the trustee is also regulated by the U.S. Department of Labor. Property managers who find opportunities in this area must take special precautions to learn and define the legal responsibilities and requirements of the relationship. While agency law presumes many rights and responsibilities of the agent property manager, the property manager's rights and responsibilities should be spelled out in detail in the property management agreement. State statutes. Each state has licensing laws and regulations governing the conduct of persons and organizations acting as real estate agents. Although these laws apply mainly to those selling real estate, property managers should investigate the statutes of the states where they manage property to be sure they are in compliance with those laws. A few states have adopted statutes that apply solely to property managers. Specific additional information can be obtained by calling the Real Estate Commission or Division, as it is sometimes called in the manager's state. Analysis of the owner's objectives. Learning objective. Explain how the owner's objectives influence the final management plan. The management plan cannot be completed until the manager has identified and analyzed the owner's goals, which will vary widely among the individual corporate, fiduciary, and government owners. The management plan may suggest changing the current operation of the property through rehabilitation, alteration, and modernization. Corporate and institutional objectives. Corporate owners can be divided into two broad classes: those who own real property as an investment. such as real estate investment trusts, REITs, and syndicates, and those who own and use real property for their own benefits. Most institutional and corporate investors have well-defined, written goals in the form of policy statements or investment guidelines that are readily obtainable by the property manager. Cooperative corporations and condominium associations may not be concerned with tenant-attracting amenities. They do show an interest in making the expenditures necessary to maintaining their property values. Fiduciary institutions become involved in real estate in two ways. One is through the services of their trust departments, which administer properties under testamentary and living trusts or as executors of estates. The other involves their investment divisions, which purchase income property. The prime concern of the trustee is maintaining the value of the property entrusted to its care while earning a reasonable income for the trust beneficiary. Government objectives. Government agencies, such as the U.S., Department of Housing and Urban Development (HUD) and the General Services Administration are interested mainly in preserving the value of the properties they administer. Most government-subsidized buildings are low-income housing developments that do not seek a high rental income. Social service and maintenance of property value are the main objectives of most government agencies involved in real estate. Individual owners' objectives. Many individual owners are private entrepreneurs seeking profit or cash flow from their investment. Because most owners probably have never developed long-range plans, a property manager can make a real contribution by assisting the owner to commit to a set of written goals. The manager can help the owner establish reserves and schedule appropriate maintenance. Some owners are only interested in collecting rents and not in preserving the property. This goal may be at the expense of the tenant's expectations and comfort. If the manager determines that this is the situation, the manager may wish to withdraw from the management of the property. The management contract. Learning objective. Identify the essential elements of a management contract and change of management procedures. The management contract is a dated agreement signed by both the manager and the owner or the owner's authorized representative that defines the relationship between the parties, serves as a guide for the operation of the property, and provides a basis for the settlement of any future disputes. Management contracts are as varied as the types of real property and the forms of real estate ownership. Specific circumstances aside, most management contracts share the following essential elements. Identification of the parties and the property. Period over which the contract is to run. Authority and responsibilities of the manager. Responsibilities of the owner. Fees and leasing sales commissions. Signatures of the parties. Management contracts are as varied as the types of real property and the forms of real estate ownership. Specific circumstances aside, most management contracts share the following essential elements. Identification of the parties and the property. Period over which the contract is to run. Authority and responsibilities of the manager. Responsibilities of the owner. Fees and leasing sales commissions. Signatures of the parties. Identification of the parties and the property. The owner's name ought to appear on the contract exactly as it does on the title or deed to the property. Required signatures vary depending on the type of ownership. The property must be unmistakably identified. Parties vary. If the property is owned by a partnership, each partner's name should be stated in the contract, and each should sign the document. With corporate ownership, the corporate name should appear on the contract. A duly authorized corporate officer should execute the agreement, and where required, the corporate seal should be affixed to the document. When applicable, the management agency, rather than the specific individual who will be in charge of the property, should be listed on the contract. In many states, licensing laws require all listing and management contracts to be signed in the name of the broker. Laws in effect in the state where the property is located should be followed. If the manager represents a management firm, the manager will sign as the authorized representative of the firm. Identifying the property. Although a full legal description usually is not required, the property must be described so as to leave no doubt concerning its identity, location, and extent. For individual houses, the street address of the property often is sufficient identification. With commercial property, it is important to supply the street address plus a careful description of the exact land area and both main and auxiliary buildings to be managed. If the property has a special name, as is frequently the case with apartment complexes or shopping centers, that name should be specified in the contract. exclusions should also be noted. For example, if the owner of an office building that has a restaurant and bar on the first floor wants to deal directly with the restaurateur, the property description in the management contract should specifically exclude that particular area. Contract period. Next, the contract must stipulate a term of service. There is no single standard term for a management contract. Its length is a function of the size of the property, the responsibilities delegated to the manager, and the future intentions of the owner or owning body. Terms vary. Long-term contracts are uncommon. Some owners want a provision for cancellation. Other owners may be thinking of selling their property in the near future and do not want to hinder the sale with a long-term management contract that cannot be canceled. Thus, clauses in standard management contracts leave the length of the agreement open so that a mutually satisfactory number of years can be inserted in the appropriate blank. Contracts may be for a definite period of time or may also contain a provision for automatic renewal on a yearly basis unless notice of termination is given within the period set forth in the contract. Termination. Generally, language is included to permit either the owner or the management agent to terminate the agreement by giving appropriate notice. Most agreements may be terminated before their expiration date by the agent if she may suffer damages or liability as a result of the owner's failure to comply with the requirements of any applicable state law or government regulation. In such cases, cancellation takes effect when the owner is served with notice of the agent's intent to terminate the agreement. The longer the agreement, the more likely things will change. Management's responsibilities. The manager is responsible for conveying to the owner information regarding the property. The following reports offer an idea of the status of the property and insight into the effectiveness of the owner. Monthly reports and disbursements. The owner depends on the agent to prepare a monthly earnings statement itemizing income and expense for the owner's property. The management contract should specify the name and address of the person, corporation, or board of directors, as in the case of a cooperative or condominium, to receive the report and the date on which it is to be submitted. The names, addresses, and percentage amounts for all recipients to whom the agent must dispense monthly payments usually are listed in the contract. The contract should clarify how to deal with a month in which disbursements exceed receipts. Under some contracts, the manager is authorized to hold a certain sum of money in reserve to meet expenses that may come due between the time of disbursements and the time the next monthly rental income flow begins. The entire amount of this reserve fund should be proportional to the size of the property. Agents should not generally advance their own funds to cover a deficiency. Fidelity bonds. As a rule, the property manager's employees who handle funds have to be covered by a fidelity bond obtained at the manager's expense. A fidelity bond is insurance protection in that it pays if named individuals commit theft of money or property. Handling funds. Most contracts and most state laws require the manager to maintain a separate bank account for the owner's funds. That is, the owner's funds should never be commingled with the agent's personal or business funds. Traditionally, if the manager worked for more than one owner, the manager set up an individual account for each client. However, with today's software programs, the manager can easily track deposits and expenditures in one bank account without the necessity of multiple accounts, checks, and deposit slips. Authority to rent, operate, and manage premises. The terms of the contract should list the agent's authority to lease, collect rents, terminate tenancies, return security deposits, evict tenants, and bring legal action for recovery of lost rents. The most important is the agent's authority to sign leases, for the statutes of fraud in most states do not consider an oral lease agreement of more than a certain duration, usually 1 year, to be enforceable. Some owners insert a clause in the contract limiting the agent's authority to sign leases to a certain dollar amount or to a maximum period, such as 5 years or less in the case of many commercial properties. Agents for residential properties generally have the authority to sign standard leases for the maximum term established by the owner's policy. Expenditures. Expenditures for maintenance, personnel, and services are an inherent feature of property management, but the amount the agent may incur without consulting the owner must be stated in the contract. Some contracts contain a clause that gives the agent the power to enter into contracts not to exceed a certain amount for utility services, rubbish removal, window cleaning, or other recommended services. For the protection of the agent, such clauses should carry a caveat making the owner responsible for any such agreements upon termination of the contract. Expenditures. Expenditures for maintenance, personnel, and services are an inherent feature of property management, but the amount the agent may incur without consulting the owner must be stated in the contract. Some contracts contain a clause that gives the agent the power to enter into contracts not to exceed a certain amount for utility services, rubbish removal, window cleaning, or other recommended services. For the protection of the agent, such clauses should carry a caveat making the owner responsible for any such agreements upon termination of the contract. Marketing costs. Advertising is considered part of the normal operating expense for many properties and, as such, is usually charged to the building and absorbed by the owner. The amount of the advertising budget is typically recommended by the management company and approved by the owner. Agent's control over personnel. The management contract should also specify the agent's powers to hire and fire maintenance personnel for the premises. These powers will vary from contract to contract. As a general rule, though, the manager who is going to be responsible for the work done by building employees should also have the power to hire and supervise them. A manager who is permitted to hire the operating staff is usually expected not only to obtain liability and workers' compensation insurance for building personnel, but also to file returns and other reports required of the owner-employer by federal and state governments. The manager who hires and supervises employees must also decide whether the salaries of building employees and clerical staff will be charged to the building or to management operations. These expenses, which can have a major impact on financial statements and returns, should be clearly stated in the contract. One difficult situation occurs when the owner reserves the right to hire, supervise, and fire employees who work at the property, particularly when building personnel have been employed by the owner for a long period of time. If this is the case, the property manager should seek protection through a clause stating that building personnel are employees of the owner, not the agent. This clause should explicitly set forth the owner's obligation to pay all settlements, judgments, damages, penalties, back pay awards, court costs, attorney's fees, and other costs arising from litigation of claims, investigations, or suits that may arise from alleged or actual violation of state or federal labor laws. Owner's responsibilities. The management agreement should spell out the owner's responsibility for miscellaneous management expenses. It should contain a clear statement designating the person responsible for each item of management and maintenance expenses, including the following: payroll, maintenance, security, and supervision, insurance, employee and fidelity premiums, payments on owner's behalf, bookkeeping and auditing, building expenses and repairs, advertising for tenants, management fees, payroll. Unless previously agreed upon, the management contract should also clarify whether the manager or the owner is the employer of the maintenance employees. The employer may not actually be the same person who is responsible for hiring and supervising the employee. Some management companies engage a third party to process all paperwork necessary to meet all statutory requirements governing the employer-employee relations, including payroll. The employees work for the employer. The third party simply exercises all human resource responsibilities. Insurance. The contract also should specify that the owner will carry, at the owner's own expense, sufficient liability and workers' compensation insurance. The owner and the manager should be named as co-insureds or additional insureds on these policies, and the owner should provide the manager with certificates of evidence for such coverage. For the manager's protection, a stipulation should be included that the manager may purchase such insurance at the owner's expense if certificates of coverage are not produced within a reasonable period. It is in the manager's best interest to review the terms of these policies, for the owner usually looks to the manager to work closely with the insurance agency to settle any claims that might arise. Purchasing. The owner should agree in the contract to give the agent a schedule of payments that must be made for debt service, taxes, special assessments, or insurance premiums. The manager can then budget or establish reserves for these items, building repairs. It is important for the management agreement to contain a clause that requires the owner to make any repairs and replacements necessary to keep the premises in their current condition and operating efficiently. Thus, the owner will be responsible for complying with the terms of the lease agreements, minimum housing codes, and any other applicable laws. Minimum information. At the minimum, the manager should obtain the owner's name, address, phone number, social security or tax ID number, and state employment number, as well as the name, address, and phone number of the owner's attorney, accountant, insurance broker, and any other consultants for the property. If the property is new, the manager should be given the name of the architect and the construction firm, as well as a complete set of as-built building plans and specifications. The owner should supply the name and address of any mortgagees, as well as mortgagors under any assumed mortgages on the property and the amounts and due dates of loan payments, real estate tax bills, and existing insurance policies. The owner also should furnish copies of all contracts for services, employment records, and federal and state employment reports. The record should include wages, pay periods, social security number, and fringe benefits for each employee. Finally, the manager must obtain the names, addresses, and telephone numbers of service contractors such as plumbers, electricians, suppliers, and on-site employees. Lease information. The manager must have a listing of all rental units, copies of all leases, and a schedule of rental rates for each space. Additionally, the manager will want to know layout plans, the names of the present tenants, all available financial data, the current dates to which rents have been paid, any present delinquencies, and the sources and amounts of additional income. In many cases, the manager will have to prepare these schedules from basic documents because some owners do not keep complete and well-organized records. Accounts payable. The owner or authorized representative of the owning corporation and the manager should study the accounts payable ledger when the management agreement is executed and agree on each party's specific liabilities for expenses. Unpaid bills should be tended to, and the parties should set an exact date on which the manager will become responsible for paying expenses from allotted funds. After receiving the necessary information from the owner, the manager must set up accounting records. Notice of the takeover should be given to all suppliers, service contractors, on-site employees, and tenants. Security deposits. Accounting for tenant security deposit balances is an essential part of any takeover. In many states, failure to return deposits or pay interest when required is a violation of the landlord-tenant law and grounds for real estate licensee disciplinary action, and it may also incur costly monetary damages. Determining property profitability. Learning Objective recognized 3 methods for determining profitability. The manager's monthly income and expense reports, profit and loss statements, and cash flow analysis help the owner decide whether the property is profitable enough to keep. In addition, they form a basis for judging the manager's competence. The owner and the manager may consider one or more of the following 3 methods. Break-even analysis, return on investment, capitalization rate. Determining property profitability. Learning Objective. Recognize 3 methods for determining profitability. The manager's monthly income and expense reports, profit and loss statements, and cash flow analysis help the owner decide whether the property is profitable enough to keep. In addition, they form a basis for judging the manager's competence. The owner and the manager may consider one or more of the following 3 methods. Break-even analysis, return on investment, capitalization rate, break-even analysis. The primary method of calculating the profitability of a building is to determine its break-even point, the percentage of occupancy at which gross income is equal to fixed expenses. In large commercial projects, a break-even analysis is done to determine if a project is leased up to its break-even point, often before a permanent lender will fund a takeout loan. When gross income exceeds the break-even point, the project will begin to be profitable. The formula for calculating a property's break-even point is shown. Break-even analysis. By using the monthly income and expense reports for the property, the manager can first differentiate between the fixed costs FC and variable costs. Fixed costs remain the same whether or not a single unit is rented and include salaries, mortgage payment, insurance, and property taxes and expenses related to new capital expenditures. Variable costs are those that change according to the units rented. Examples include management fees, maintenance expenses, utility costs, and so on. Return on investment. Another measure of profitability is the ratio of the property's net income after taxes to the money invested in the property investment, called return on investment, ROI. In other words, this is what the owner paid, and this is the owner's return. This ratio can be converted into a percentage return on investment and measured against the owner's desired yield. In formula form, the return for a particular owner on the owner's investment can be derived as follows. Capitalization rate. Another index of the profit on a particular property is the capitalization rate, an analysis of the projected net operating income NOI. For comparison and measurement purposes, return is expressed through capitalization rates. Essentially, the capitalization rate converts future income to a present value. The rate is a number assigning a relationship between income and value. It is capitalizing the past and buying the future. The general formula for calculating the capitalization rate is as follows. The rates, which are not actually percentages, indicate a level of risk. The lower the risk, the lower the cap rate, the greater the risk, the higher the cap rate. For example, when purchasing a building with a 20-year lease with an insurance company, the investor might be content with a rate of 8. On the other hand, the investor might look to a higher rate of 12 when purchasing a multi-tenanted residential property with a higher risk and much more management. The cash flow or income is going to stay the same regardless of what the investor pays. Here's how it works on a property generating income of $100,000. The investor looking for a cap rate of 10 will expect to pay about $1 million. The investor who knows that the building and income are a bit riskier and more work will apply a rate of 12 and pay only $833,333. Another point of view is what is good for the buyer. Cap rate of 12 is not necessarily good for the seller. Here's a true story. An inexperienced manager who did not understand the difference advised his client seller to ask for a higher cap rate. The astute buyer went along and negotiated an even higher cap rate, which was agreed upon, losing the seller thousands of dollars. Making upgrades to reduce energy consumption can potentially increase value when determined by cap rate. Energy Star, a program sponsored by the Environmental Protection Agency EPA, estimates that every 10% decrease in energy use results in a 1.5% increase in NOI. After installing energy upgrades which reduce energy consumption, suppose that the income of the building was increased by 1.5% to $101,500. Assuming the same level of risk, apply the cap rate of 10. The building is now valued at $1,015,000. Often investors will compare capitalization rates of similar properties to determine the quality of the investment in the subject property. This is an estimate that depends on careful and objective selection of true comparables for its validity. Maintaining relationships. Learning objective. Summarize how to maintain satisfactory relationships with owners. Continuing owner-manager relations. Having assumed responsibility for the property, the manager must now begin to build a mutually satisfactory relationship with the owner. The owner or the owner's authorized representative should get to know the person or persons who will actually manage the property, who may or may not be the person who negotiated the agreement. However, in many large management firms, if a corporate officer executed the contracts, then it is wise to introduce the owner to the specific account executive for that property. To avoid confusion, from this point on, only one member of the management firm should deal with the owner. The account executive, the person most responsible for the property, can build a smooth and profitable working relationship between the owner and the management firm by being fully apprised of the particulars of the premises. Monthly reports. The monthly earnings report is often the principal means of regular communication between the manager and the owner or owning corporation. These reports usually include rental receipts, miscellaneous income, gross income, an itemized list of all disbursements and operating expenses, total expenses for the month, cash on hand at the beginning of the month, amount forwarded to the owner, and cash balance on hand. Ideally, the manager's software program provides easy access to any reports the owners may want. Such reports could be financial statements reports and easy access to email the property manager. In addition to the monthly financial reports, managers should strive to provide some form of personalized contact, such as a short visit, telephone call, or email with the owner or the owner's representative. Letters and email messages can be used to reach an owner who is out of town and to confirm decisions already reached through personal discussions or telephone conversations. One of the best ways to keep owners happy is to keep delinquencies to a minimum and to provide information about any upcoming issues or problems. The manager should be the one to inform the owner, not a tenant contacting the owner directly. Either in the monthly report or in a separate letter, the manager also should inform the owner of delinquent accounts and other events pertaining to the operation of the property. Above all, the monthly report should be honest and intelligently written to assure the owner that the manager understands how all the variables interact to affect the revenue from the property. The manager can demonstrate continuing personal interest in the property by always including a cover letter along with the financial report. In routine months, the letter will probably say nothing more than operations were normal. The manager should explain unusual items in either the expense or income columns. If the normal income is lower than the owner anticipated, it is likely that he will think that the manager has failed in some way unless the manager offers a reasonable, clear, and convincing explanation of market trends or other controlling factors. If the monthly revenue is greater than expected, the manager should explain unusual items in either the income or expenses of the property. Ongoing contact. A successful property manager must have the ability to manage human relations, and effective communication is a large part of this facet of the property manager's job. The manager must know what kind and frequency of communication the owner wants and how to fulfill that need. The contacts may be by phone, printed documents by U.S. mail, or by email. The manager's ability to care for the property, coupled with the goodwill arising from personal contact with the owner, will build a lasting and mutually profitable business relationship between the parties. The manager must know which types of information are important to which owners and make sure they are informed accordingly. Furthermore, the property manager must be able to deal effectively with a variety of personalities and temperaments. Different degrees of tactfulness or bluntness are required for different types of people, and maintaining a productive working relationship requires the ability to tell when each is to be used or avoided. Key point review. Property managers may be involved in the real estate management profession in one of three major ways. As individual managers who are directly employed by owners of individual buildings. As employees of management firms that hire property managers to oversee numerous buildings under their care. As employees of real estate agencies that offer a variety of services, including a property management division. Managers may be either employees or contractors, agents of the owner. Those who work for management firms and real estate agencies are employees of the organization, which in turn is the agent of the owner or principal. How to cover expenses in months when income is inadequate. Manager's power to rent and operate the premises. Manager's authority to sign leases. Manager's role and financial limit in contracting for utility services, rubbish removal, or other maintenance services. Manager's role to hire and fire building personnel. Manager's responsibility to obtain liability and workers' compensation insurance. Owner's responsibility to obtain liability and workers' compensation insurance. The contract should clearly state the amount of the fee, when it is to be paid, and in what manner. Independent agent managers may charge a flat fee or a percentage of gross collectible income. Sometimes an additional fee is paid to managers for their leasing activities. A principal-agent relationship is created with a written property management contract signed by both parties. Certain legal and ethical considerations due the owner from the manager are implicit in this agency relationship. As agent for the owner, the manager must be loyal and pledged to act in the best interest of the principal and to handle all transactions in regard to the property with honesty and discretion. A properly drawn contract outlines the responsibilities of the property manager. Management contracts should contain most, if not all, of the following: identification of the property and the parties to the agreement, term of the contract and provisions for extending or terminating early, manager's authority to make expenditures for normal operation of tire premise without consulting the owner, how to cover expenses in months when income is inadequate, manager's power to rent and operate the premises, manager's authority to sign leases. Case study: the owner relations manager. Jennifer Johnson, CPM, is the owner of accredited management organization which manages property for individuals, pension funds, and trusts. She started her property management career as an employee of a company that managed investment properties for a large number of owners, and the owner of this company was a dynamic individual who had built up the business over many years. When the owner died, however, succeeding managers failed to maintain good relationships with the client property owners. After losing many clients, the company was forced to close. One disgruntled ex-client, for whom Johnson had been the principal manager, encouraged her to set up her own company and subsequently transferred its holdings to her to manage. To avoid a similar situation with her own company, what can Johnson do? How can Johnson add clients to her own company?
Wonderful work. You've made it to the end. Congratulations. And most specifically on that case scenario, it is really important that you remember to keep up these good relationships with your owners. And as you can see, sometimes that happens is that there's a really, really good employee in a large management property situation. And maybe the owner loves that employee, but doesn't necessarily like the business. So, yeah, it's very, very important that you have a good working relationship and continual communication with that owner because ultimately they decide who it is that they want to work with. All right, on to the next chapter. Good job.